Bitcoin has plunged into the 85,000 region, a drop of more than 30% from the all-time high of 126,000 recorded in October. In traditional markets, this alone would be enough to formally declare a technical bear market, no debate needed. In the United States, anything over a 20% decline is already considered a bear market. And once again, the same question appears, the one that always surfaces when Bitcoin falls sharply. Is this the end of the cycle? Or, for the more catastrophic thinkers, is this the end of Bitcoin itself? Or is this simply another one of those moments that look like the end of the world in the short term, but turns out to be nothing more than noise, and often a great opportunity to buy Bitcoin at attractive prices? That's exactly what I'll break down in today's video, the potential reasons behind this drop and an especially interesting point about MicroStrategy. Before we dive in, a quick reminder about My Profits Black Friday. It's the platform I use in my videos to track portfolio performance, calculate profits and losses, generate tax documents, and help with income tax reporting. They're currently running Black Week from November 24th to 28th, offering a special 2-year subscription discount. The Pro plan drops from 717 reals and 60 centavos to 417 reals and 60 centavos, a 300 real discount payable in 6 installments. The Premium plan falls from 477 reals and 60 centavos to 327 reals and 60 centavos, 150 reals off, also in up to 6 interest-free installments. On top of that, there are 2 Black Week bonuses, a live masterclass with an Avenue specialist, and the 2026 Income Tax ebook. Link in the description. I highly recommend the platform. If anyone watching is already a client, let others know what you think of My Profit in the comments. People tend to really like it. Why Bitcoin fell? 4 main factors. Sharp moves like the ones we saw in recent days are nothing new for longtime Bitcoin followers. Periods of euphoria followed by brutal corrections are simply part of Bitcoin's natural cycle. But the intensity of the recent decline caught attention, especially because of the timing. If the current cycle had ended at the 126,000 peak, its duration would be very similar to previous cycles, so the uncertainty lingers. With this drop, Bitcoin even approached the 80,000 level, making this potentially its worst month since the Terra Luna collapse in 2022, which triggered a wave of bankruptcies and eventually the fall of FTX, then the world's second-largest crypto exchange and ironically among the most regulated. When we analyze the causes of this correction, there isn't a single clear trigger, but 4 major components stand out. 1. ETF outflows, a complete shift in market dynamics. Bitcoin ETFs were undoubtedly the biggest innovation of the 2024-2025 cycle. They dramatically changed supply and demand dynamics by providing large funds, asset managers, and institutional investors simple, regulated access to Bitcoin. This created a massive, steady inflow that sustained the rally to the 126,000 peak. But after the top, inflows slowed, then turned negative. For example, BlackRock's IBIT ETF recorded a record $523.2 million net outflow on November 18th. In November alone, Bitcoin ETFs saw more than $3 billion in net redemptions. In other words, what used to be a major source of demand has now become a major source of supply. Without positive inflows, Bitcoin lost the support that fueled its cycle. ETFs stopped pushing the market upward and began pushing it downward, accelerating the decline. 2. The macro environment turned hostile. For most of the year, markets were pricing in interest rate cuts in the US. While that expectation held, risk assets thrived. Many markets remain near all-time highs. It's almost as if Bitcoin is the only one left behind. But narratives change quickly. US inflation began showing persistence again, undermining hopes of a year-end rate cut, even though the labor market weakened. The Federal Reserve has a dual mandate, inflation and employment, unlike Brazil's central bank, which focuses solely on inflation. Fed Chair Jerome Powell, who earlier hinted at possible easing, shifted to a much more hawkish tone. In October, he stated that a December rate cut was not inevitable. Other Fed members echoed this message. On top of that, the US went through a 40-day government shutdown, freezing the release of key economic data. Without data, volatility increases and risk appetite decreases. Tensions between the US and China escalated. US equities briefly declined, though they've since recovered to near highs. The tech sector is extremely volatile, sometimes labeled a bubble, then posting record profits the next week. Overall, institutions reduced their appetite for risk, and since crypto is no longer dominated by small, idealistic retail investors, but by traditional finance players, funds, banks, asset managers, their behavior is very different. They sell when macro conditions worsen, unlike the classic crypto holders who simply keep buying. 3. The October 10th flash crash and cascade of liquidations. This is the only truly clear catalyst. On October 10th, $19 billion in leveraged positions were liquidated within hours. Markets were euphoric, leverage was high, and confidence was excessive. Almost everyone believed new highs were inevitable, but liquidity was extremely thin. Fewer market makers, less capital on exchanges, shallow order books, few buyers ready to absorb selling pressure. This created a structural fragility. When the first drop happened, it triggered liquidations. Those liquidations pushed the price lower. Lower prices triggered even more liquidations, and the cycle repeated, a classic domino effect amplified by high leverage and low liquidity. In early November, another $1.6 billion in positions were liquidated in one day. 4. Short-term panic selling plus long-term profit-taking. Two very different types of sellers acted simultaneously. Short-term holders, scared, underwater, selling at a loss. Long-term holders, some dating back to Satoshi-era wallets, strategically realizing massive profits. On-chain data shows short-term holders realized $22 billion in losses in the past 30 days, a level previously seen only during the FTX collapse and everything that followed. Intense fear quickly replaced extreme greed in the Fear and Greed Index. Meanwhile, long-term holders began distributing coins accumulated for years. One whale sold more than $1.3 billion of Bitcoin after holding for 14 years. Others sold near the 126,000 peak. Today's market, despite the drop, is deep enough to absorb such selling. A sale of that size in 2015 would have crashed Bitcoin much more aggressively due to lower liquidity. MicroStrategy, a secondary consequence. This is not a cause of Bitcoin's decline, but an important outcome of it. MicroStrategy, Michael Saylor's company, has dropped more than 40% this year. JP Morgan recently warned that MSCI may remove the company from major indices such as MSCI USA, MSCI World, and the Nasdaq 100. Around $9 billion of MicroStrategy's market cap belongs to passive index funds. If the company is removed from these indices, passive funds will be forced to sell automatically, potentially triggering billions of dollars in selling pressure. The market, anticipating this, repriced MicroStrategy quickly. Its valuation is now close to the value of the Bitcoin it holds. This doesn't mean the company will sell its Bitcoin. Saylor repeatedly states he never will. It also doesn't threaten Bitcoin's protocol, but in a fearful environment, the headline itself fuels more panic. Short-term chaos, long-term noise. Zoomed in, every daily candle looks catastrophic. Zoom out, and the same crash becomes a tiny ripple in a decade-long ocean of growth. Bitcoin has seen 30% drops many times, 50% drops in one day, 70% corrections, even within bull markets. No one has a crystal ball. This may or may not be the bottom. But historically, when fear reaches extreme levels, fear and greed around 10, long-term investors tend to find great opportunities. Many people, overwhelmed by fear, forget why they bought Bitcoin in the first place and sell for no rational reason. My view hasn't changed. The long-term thesis remains intact. Bitcoin represents digital scarcity, something humanity never had before. If I send you a photo, we both have a copy. If I send you a Bitcoin, I no longer own it. Only 21 million coins will ever exist. 20 million are already mined. Only 1 million remain for the next century, for more than 8 billion people. Generational wealth transfer alone will introduce trillions of dollars into the portfolios of younger investors who allocate much more to Bitcoin than older generations do. Is this a warning or an opportunity? Looking at the Mayer multiple, the ratio between Bitcoin's price and its 200-day moving average, the current level of 0.78 suggests the price is 22% below its long-term mean, while the historical average is around 1.29. In 85% of Bitcoin's history, the Mayer multiple has been higher than it is today. To me, levels below 1 and especially near 0.8 are historically attractive long-term entry zones. But that's just my opinion. Nobody knows the future. What do you think? Has the cycle top already passed? Will Bitcoin keep falling, and to what level? Or is this the moment to increase exposure? Share your views. I learn from you as much